So Jeremy Hunt has proposed a series of tax increases and spending cuts to the tune of £55 billion. And these are going to have a fundamental impact on most businesses and will impact take-home pay as well as how much and where people can save. Wrapped investments such as pensions, ISAs, and insurance bonds are going to come to the fore, with dividend and capital gains tax allowances being hard hit. So income tax. Personal tax allowance is going to be frozen at its current level of £12,570 until at least April 2028. The higher rate threshold is going to be frozen at its current level of £50,270 until at least April 2028. And the threshold for paying the additional rate of tax, the 45% income tax rate, is going to come down from £150,000 to £125,140, again from April 2023. Meaning that someone earning £150,000 is going to pay another £1,243 extra in tax, approximately £100 a month. So these frozen limits, well, really, they're stealth taxes dragging millions more people into paying income tax for the first time or paying higher rate tax when they were previously basic rate taxpayers. More than 500,000 people will start paying the additional rate of 45%. So what can you do? Well, paying pension contributions is a simple way to reduce tax bills, especially for those of you who start paying higher rate or additional rates of tax. And of course, they are significant benefits if you can get that tax relief. The tax system is crazily complex and with high marginal rates for those earning between approximately £50,000 and £60,000. And if you've got children, you may also lose the child benefit while paying that higher income tax charge. And those earning between £100,000 and £125,140 are going to face an effective rate of 60% on that portion of income because they lose the personal allowance, and 45% for those earning more than £125,000. So from the tax year 23-24, the dividend allowance is going to be reduced from £2,000 to £1,000 and then halved again from 24-25 down to £500 for individuals. So if you have a portfolio of £66,000 or less yielding 3%, then the £2,000 allowance covers this. The reductions announced over the next 2 years means that the value would be halved to £33,000 and then £16,500. Meaning, on that 3% yield, you're going to be paying more tax on your dividends if you've got a larger portfolio than that. So this is why ISAs are going to become so important. Also remember independent taxation. Move assets from one spouse to the other or one civil partner to the other to make sure that you're utilising both of your allowances if that's possible. This type of dividend income is applied after non-saving and saving income, so this could increase the number of people paying higher rates of tax on this income, especially if combined with additional rates of tax being reduced to £125,140. It's bad news for the average investor holding money in what we call unwrapped in portfolios. That's outside ISAs, outside pensions. There could be an opportunity here for you to take your gains in any portfolios and invest in ISAs and pensions. But when you've already maximised those contributions already into those tax advantage products, investment bonds could provide a real opportunity without limiting your investment options. So with the announcement that individual capital gains tax exemptions are going to reduce from $12,300 to $6,000 next tax year, that's 23-24, and then from £3,000 in 24-25, using an investment bond wrapper could enhance the tax efficiency of money, as that's treated as a non-income producing asset. If you're yet to use your capital gains tax exemption for this tax year, you've got 4 months to do so. As I said, think about the spousal exemption and, of course, think about losses that you can carry forward. The dividend tax and the capital gains tax are two tax changes alone will mean that more investors are going to have to complete self-assessment tax returns on an annual basis. The last thing I want to talk about is inheritance tax. The freeze on the personal allowances, as we know, as I've just discussed, but the inheritance tax allowances has been frozen for some time. Obviously, we've got the nil rate band and the residential nil rate band, £325,000 for the nil rate band, £175,000 for the residential nil rate band, above which inheritance tax is going to be payable. Of course, you've both got that if you're a couple, a civil partner couple and married couples, not cohabiting. Those allowances have been the same, or the nil rate ban at 325 has been the same since 2009. So more and more people are being caught by inheritance tax. So you need to plan early. You can plan early. We do a lot of planning here at my financial planning firm, mitigating inheritance tax as much as possible. And of course, the classic one is give some assets away if you can afford to do so. Sometimes using trusts, of course, that's something that you should take advice over. Remember, not everyone will have a residential nil rate band. There is certain qualifying criteria. And of course, net estates over 2 million are going to start having their residential nil rate band reduced by £1 for every £2 they're over the £2 million threshold. The good news was the government confirmed the state pension triple lock is going to be honoured, which means state pensions are going to be increased in line with inflation from 2023. That's going to be a 10.1% increase. So the state pension is going to go up from £9,627 a year to approximately £10,600 a year. However, given inflation for pensioners is likely to be higher than the headline 10.1%, it may not completely cover the increases that you're seeing on your outgoings. Also, there is a sting in the tail, with the personal income tax allowance frozen at £12,570 until at least April 2028. If there are future triple lock rises between now and then, the single-tier state pension will be very close to the £12,570 figure, potentially dragging millions of more pensioners into paying income tax. I hope that's been helpful. My name is Justin King. I'm a chartered and certified financial planner, and my aim is to help people have successful lives, and that often involves understanding your money. I have a podcast called the Retirement Cafe Podcast. I'll put a link in the notes below so you can take a listen to that, of course. And of course, you could also sign up for my weekly newsletter, which is packed with inspiration and tips regarding retirement issues. I hope you've enjoyed the video. If you have, please press the like button and, of course, subscribe so you never miss an episode. Thanks for watching.